This is Jim from Portage M&A Advisory, and you're listening to the Selling Successfully podcast, the show that simplifies selling your business for those thinking about moving into the next chapter of life. If you like what you hear, please follow or subscribe to find us easily and listen again. We're here when you need us. Today we're getting the inside scoop from someone we know well. Sean Brown is joining us today. He's the owner, business owner, private equity group owner of a manufacturing portfolio. Really excited to talk about Sean because he's the first buyer we've had on. So welcome, Sean.
Good morning, Jim. Thanks for having me.
No, I appreciate you joining us. We obviously have a bit of a working relationship in that we were able to broker a deal together, and you learn a lot about an individual when you go through the purchase or acquisition or the brokering of a deal. And I think there's a lot that folks can really learn from your experience, especially those looking to acquire. So really excited to talk more about the path. The deal that we worked on was Burloak Tool and Die, which is a manufacturing company. We were brought on to help the two owners exit, move into retirement, and we're really grateful that we found you and you were able to fit in really nicely and now I guess grow your portfolio. So thank you very much.
Oh, the pleasure's mine. We're grateful too. We're glad you found us.
So Sean, we know when buying a business, one of the most difficult pieces of the equation is coming up with the right price and the right deal structure. As a private equity group owner, this is something that you got to really think about. You're thinking about the financial performance. You're thinking about the industry, the outlook of the industry. You're managing that with investor expectations. Can you talk to us a little bit about this and, where your head goes when you're thinking about making an acquisition?
For sure, Jim. Happy to. Well, it's interesting. There's a lot to learn, as you noted. One of the ways I think about it is, there's a difference between risk and uncertainty, and I've always thought of, risk is the probability of something you know about that's bad happening to you. But uncertainty is the probability of something bad happening to you, but it's something you don't know about. So you cast a wide net when you're looking at these things because, you can price in risk and you can figure out how to mitigate risk. But if you cast a wide net and you can sort of eliminate uncertainty or at least identify it so it becomes just business risk that you can figure out how to contend with rather than something coming out of the clear blue sky and walloping you, then that's a good thing. So for that reason, it's important to take a good comprehensive look at the business and the environment in which it's operating, the people involved. And to do that, you have to have good quality people on all sides of the deal. You're always interested in a quality seller, a quality broker or agent or representative that's working with the seller. Do they have a quality team behind them, whether it's legal or accounting or otherwise? And then on sort of our side of the table, so to speak, although I kind of hate that analogy, you're looking to see that you've got a quality team put together as well, because people have different views and come at it from different angles of incidents, and hopefully, by the time you're done, you've covered all your blind spots.
Right. And it's interesting, your perspective, because, through this sale process of Burloak, for example, we found a lot of groups had a very defined check boxes that they needed to go through, a list of check boxes where, hey, customer concentration doesn't quite fit our expectation, we're exiting. And what we found in the lower mid-market in particular is that, there are nuances in every business. And I think that there's risk in every business, but it's really understanding the risk. So, when I met you, I was fascinated with your approach because you were looking at the fundamentals, you were looking at the people behind the business, and you were really trying to understand what made the business tick. But, when you first see an opportunity, where does your head go first, and what are you really trying to determine to really see if it's worth taking the next step?
Well, from the get-go, you're trying to establish trust. And you can look at that a bunch of different ways. Do I trust the seller? Do I trust the representatives? Do I trust that I understand how this business makes money? Do I trust that this business is going to continue to make money in the future? At the rate it's currently been. Quite often you find that sellers are quite hung up on, the money that the business has made in the recent past. But from a buyer's perspective, you really have to figure out how much of that is extensible into the future. And do I trust my own ability to understand that and get my head around how it makes money, how that entity delivers value for its customer base? Because at the end of the day, that's where all the money comes from, that business's customers. So you are looking at it from a bunch of different ways. Not that I would be using trust in a typical way where you're saying, oh, is this guy trying to beat me, or is he trying to offload a dog or whatever? I think in most cases that's not the case, and especially when they're working with a trusted advisor, an advisory firm of some kind, and you just want to know, have I got my head around how these people operated, what kind of a business they put together, because you want to establish the caliber of the place.
Right. Yeah, and what I find too is, we get different types of buyers who have, different objectives, and sometimes I find people are one-dimensional in that they're trying to determine what the value of the business or the expectation from the seller, and oftentimes, what we share with our team is that, listen, like we have to look at the quality of the individual, the buyer, and we have to determine whether or not it's going to be a good fit. And if they get fixated on the financials alone, they're probably missing the boat, because the relationship between buyer and seller is so critical. And similarly, we do a lot of coaching with the seller to say, listen, I know you're fixated on a certain value you need to have, but at the end of the day, fit is extremely important, and you got to put yourself in the buyer's shoes, because you mentioned earlier, there's always risk. There's risk that you're going to start operating the business and the customer perhaps had a very close relationship with the seller in the exit, right? And oftentimes sellers have a hard time grasping these concepts that a buyer is dealing with. So that's something that we feel is really important. How do we get them to understand your perspective and vice versa? And you came to the table, and I think the thing I really appreciated is that you were trying to understand what Les and Arnold really wanted out of this, what were their personal objectives, and then also looked at the business from a more holistic standpoint. Would you say that's accurate?
I would, and they were pretty straightforward with us. Most everything. I can't think of any exceptions that they presented to us as being the case. In fact, played out that way and turned out to be true, because here we are, quite a bit past the transaction, and
right.
and you're always worried about, I call them Easter eggs. What are you going to find? Maybe not Easter eggs in the good way, but what are you going to find that's unexpected? After closing, and there really weren't many surprises. If any, nothing material that comes to mind, and I attribute that to the job that you did with them, but also that it was in their nature to be pretty straightforward with us. Things worked out fairly well in terms of the understanding we got about the business at the time they were presenting it to us. In fact, turned out to be the case.
Right. So Sean, let's dive into what you typically see when you're sourcing opportunities. You go out, you probably talk to numerous advisors. You probably have a few ideas in terms of outreach, looking at different businesses. What are the typical challenges you face when you're reviewing teasers and opportunities?
Well, it's all over the map, really. There's sometimes there's not a teaser, or it's very vague. That's okay. But once you get into the business, it's pretty important that there be a good, healthy flow of information, and without us getting the feeling that there's anything really being held back, because that can kill a deal pretty quickly. We were looking at a business, I obviously can't say what or what industry, but looking at a business a couple of years ago, and the prospective seller disclosed that they had reasonably high customer concentration. That's okay. We know how to contend with that. And then I found out, doing some cursory due diligence, that the customer with all the concentration happened to be a very close relative of the seller, and he didn't disclose that. And that ended the process for us right away, because it calls into question all kinds of things. First of all, why didn't he tell us? Will that relationship continue when he's no longer the operator of the business? How does that relationship influence pricing and margins over time? There's a million questions that arise, and that was just too big a rock for us to put the effort into solving for. So there's a lot of different things that you want to look at. A challenge for sure is if the seller hasn't disclosed something, it just calls everything else into question. So it slewfoots the trust that we've been talking about, that you try to build right from the get-go. Financial information that doesn't play out can really undermine the process as well. Sometimes there's debt involved in the transaction on the seller side, and that's quite common actually. And when you present financial information, early in the process to a prospective lender, they'll put together a term sheet or start to work on deal structuring that is condition precedent on the financials you've provided, which have only been provided to you by the seller. You don't have anything else. And then if you go through your financial due diligence and find out those are overstated by 20 or 30 or 40% or any kind of material number, the whole thing can blow up, and you're actually well into the process. Both sides have spent a lot of time and a lot of money in the process at that point. So, you do want to try and establish early on what are the things that are going to, potentially kill this deal, and make sure that those things, aren't true early in the process. Financial information for sure, not disclosing important information for sure. If it's an industry that you don't know, it's helpful if the seller can guide you to some quick ways to understand that industry, whether it's, references, case studies, here's the major trade shows in this industry, here's some industry publications. So if it's an industry you don't know very well, you want to get your head around it as quickly as possible. When we came to the Burloak tool opportunity, I didn't personally, and we at Summit Ridge didn't know anything specific about the tool and die industry, but I've been in manufacturing or operations in some way, shape, or form most of my life. So that gave me some tools to at least, approach it and tackle and understand the industry. But there's other industries where that's not so much the case. So you need to try and get your head around how does the company make money, and why do people choose that company as quickly as you can. Yeah,
and that's fascinating that you say that, because when we're looking at opportunities to represent sellers, we're going through a similar checklist. I mean, we're looking at the quality of the financial information available. We know that it's going to be scrutinized by the buyer. We know oftentimes there's the quality of earnings. So due diligence is real, and fabricating numbers it's very short-sighted in our opinion. It's going to blow up. And I think we've always been adamant that we take on opportunities on the sell side where folks are being transparent with us. They're putting all the cards on the table, and they're comfortable with us sharing information with the buyer and being transparent, because it will come up. It's gonna eventually find its way to the surface, whether it's through due diligence or afterwards. And with reps and warranties, it's not a good way to operate either, right? When you're not being truthful or transparent.
However, to be fair, there are lots of great quality businesses out there that just don't have that caliber of financial information because they've never had to operate that way. It could be that they're so profitable that they don't have any bank debt at all, so that external impetus for sound or high caliber financial reporting just isn't there. And they know that when they buy something for 40 cents and sell it for $1, they're doing okay. And that's okay. That could be a great quality business. So there can be a great quality business behind financials that don't look like they're top professional caliber to a propeller head of some kind. But that's where the broker comes in, and the broker can help interpret that story. Otherwise, it's just a lot of heavy lifting for any prospective seller.
So, Sean, we touched on some of the difficulties and challenges and hurdles when looking at acquisition opportunities. We're a huge believer too in having good, solid deal teams on both sides, and I really believe it drives the success of getting the deal completed. What's your experience? With good deal teams, and how do you approach this topic?
It's a prerequisite, simply put. I mean, there's two parts to it. One is, of course, our own deal team, because once you have a basic agreement or a letter of intent in place with the seller, then you're push and go on an awful lot of things. You've got a number of work streams happening simultaneously as you move forward to try and close the transaction. And at Summit Ridge, we we close on the LOIs that we sign, and a lot of people don't. There are strategies out there. They're just a different business strategy than Summit Ridge, where they will submit an LOI that they know is high, or they've left things out, and then they figure, they rely on sunk cost fallacy. We'll get deep enough into this deal that we can renegotiate later in the deal and hope the seller doesn't walk. And that's just not how we work. So it puts us at a little bit of a disadvantage with LOIs because they're quite solid. But then we actually close on the LOIs we sign. So that's good. But you couldn't do that without a strong deal team between LOI and closing. And you've got streams of due diligence. You've got due diligence, you've got arranging funds, and you've got documentation. And in due diligence, you've got operational due diligence that we would conduct ourselves. We would engage a firm for legal due diligence. Then there's financial due diligence, which is often referred to as a quality of earnings report or a proof of cash report. And that needs to be third party if you're raising any debt, because that's just what banks require, arm's length. Insurance due diligence, we'll have an agent just do a review of the selling company's insurance situation. And then on the cash side, you've got your own cash reserves. You might or might not be complementing that with some kind of equity raise with some private investors that might be interested in partnering with Summit Ridge or whatever the firm may be to access private investing. And then you might have equity as well. So you've got a work stream for equity with the bank or whoever it is you're working with, and they've got an entire workflow there as well that you have to comply with. And then on documentation, you've got the SPA or the APA, the share purchase agreement or the asset purchase agreement.
Yeah.
That's a considerable work stream of its own. And then you have whatever else is unique to that business. There could be leases, employment agreements, vendor take-back agreements. So there's quite a bundle of paperwork, that's due at the end of the day. So all these things take experts, and the better your team is, not just in terms of the caliber of their review, but the speed at which they can work, the better chances you have at closing well. So one of the things that we make sure we bring to the table at Summit Ridge when we're trying to be the preferred choice of the seller, to partner with us on the next steps for their company and its people, is that we bring to the table a super professional deal team that gets things done in an expeditious, professional manner, and it's worked out well for us. We're doing the same thing when we look at the seller's business. Do they, for example, do they have a lawyer who's done deals before? Somebody not familiar with the process might think, oh, great, the seller's lawyer does divorce law or something like that as a specialty, and they're handling this deal, so we're going to have an advantage because they don't know corporate. It's not at all the case. You really want the seller, for example, to have a great legal advisor, because then they understand what's market, what's not market in terms of terms and just all the aspects of the SPA, for example, and also they understand timelines and how to get things done. And importantly, and this is where a quality broker, a quality legal advisor, and a quality accounting team on the seller side can really help bring the deal to fruition, is that the seller then has a team of trusted advisors, so they can, yes, tell the seller what's market on certain things, but also just explain the process to them. Otherwise, are we as sellers supposed to explain the concept of net working capital and how it's adjusted at close and post-close? That's a hard thing for some sellers to get their heads around, and certainly we can explain it to them, and we've done that. We've done deals where there's not a broker involved, so that can be successful. But if you're on a timeline and trying to bring a transaction to fruition on a certain date, it's certainly helpful if the person has a broker who they can turn to and say, okay, explain that to me again, interpret this for me again, tell me how this works, and it's coming from someone that essentially works for them, because is getting paid by a successful close, not coming from the seller. So we prefer that. So the caliber of the people on all sides, we just think of it, all those people as the deal team. And in fact, the day after we sign an LOI, the first thing we do is we have a one-page sheet, which is the deal team that's going to get this entire transaction across the finish line for the buyer and seller together, because they both have the same goal at that point in time.
No, it's interesting that you say you mentioned a couple of key risk factors that we usually will identify, and legal counsel on the sell side is usually the key piece, right? Oftentimes, if they haven't done deals or their specialization is not in M&A, our concern is always that they're not going to play nice, they're not going to understand the overall market conditions, they're not going to be very acceptable of what the buyer is up against. And we find if legal counsel, if the accountant is up to speed on deals, that can make a big difference. Can you touch on how the conversations typically work? Because you've got a legal advisor, you've got likely a third party doing quality of earnings, you've got yourself. How do you manage all of that?
That's where the lead partner at Summit Ridge comes in. You're the quarterback on that. Right. You've got to bring all these different work streams together, make sure they all arrive at the same destination at the same time, which is closing date, or one of the few milestones you have along the way, and that's really what the work is at that point on the Summit Ridge side. We're doing operational due diligence ourselves, which is everything from what's going on with customers, who are key people. There's a laundry list. Hundreds of items that you'd want to delve into, but contemporaneously with that, we're also making sure, okay, is legal working at the right pace? Is the financial due diligence being done by a third party? Is that all proceeding at the right pace? And does everyone arrive at the right destination at the right time, at the same time?
Right, and I recall when we were working on, the Burloak deal, you and I had numerous touch points, throughout the week, and we had a project plan, we had legal agreements getting drafted, and we were constantly in touch talking about, hey, this is what we spoke about, let's make sure this aligns with the LOI, let's make sure that we're on time with financing, is there anything you need? Like, my perception is always an ongoing management exercise where you're managing a lot of items in your backyard, and I'm trying to ensure that, the seller understands where we're at in the process, because after the LOI is signed, the seller is really waiting to see how this is all going to play out. There's due diligence. They're a little curious if the train's going to come off the track. They're afraid of bait and switch, these sorts of things. And that's usually where the heavy lifting starts on your end.
It does, and one of the things we do, if it's not already shared by the time the LOI is executed, then the seller has my phone number and knows it's a simple thing. If they feel like they want to call me directly, they wake up, they had a dream that they should ask me a question, phone me up. Engagement, I think, is a pretty key word in this, Jim, and you want to make sure that there are ad hoc engagement and accessibility is a pretty big deal, because the buyer could have a lot of questions, and you just want to be ready to provide fulsome answers when they have it, or they might worry or stress, or even over something minor. You also want to complement that though with regular touch points. So whether it's just a weekly formal update, even though you're probably talking to each other 2 or 3 times or more in between that, but just to make sure the deal has some kind of pulse and things keep moving along. So engagement's a pretty big deal between seller and buyer, and it's funny because for the seller, in many respects, I guess it would be fair to think of closing as a bit of a finish line, and I've always kind of had a problem with the word closing for the execution of the transaction, because as someone who's typically a buyer, it's anything but closing. Right. It's opening. I mean, we've got a relationship with the seller personally throughout the process, but when you get to what people call closing, that's the start line. Right. That's the start line for us. And I know it's often said that there's 2 kinds of selling. There's selling to the Glengarry Glen Ross, get them to sign on the line that is dotted and close the deal. But there's another style of selling, which I've always found more effective, which is you're really about building a relationship to, and getting to the point where, yes, they sign a contract or whatever, but that's just the opening of what you hope is a 5, 10, 20-year relationship with your customer. deals aren't so different, even though the seller, as an individual, is likely moving on, but not always. Some people stay involved in the business for a year or two after, and we're pretty malleable with the owner. Depending on what the business needs, what's going to be best for the business's customers, and then what the person's own personal wishes and desires are. And we try to bring that all together. But where I was going is, even if the seller themselves as an individual is moving on, we're just at the start line. We're gonna have this business in our care for years and years to come. So we're going through all due diligence, and yes, we're trying to get the deal like closed, to use that awful term, but we're doing everything with the next 5 or 10 or 20 years in mind.
Right. I think that's a great perspective. We're always of the opinion that fit and relationship is the majority of the deal, and trust. So you're right, closing doesn't really seem to be the proper term from both sides of the equation.
Opening, we'll call it.
Yeah, we'll call it opening. So Sean, just to pivot here, given your experience looking at a lot of deals, working with different types of sellers, what sort of guidance or advice do you have for folks selling their business?
Well, a good deal team is great for sure. If you've got, we talked a couple of times today, Jim, about having your financials in order. Good financial information is always better, than the absence of it. But if you're working with a good broker, they'll help you a lot in preparing the right kind of information that a seller would be looking at, and perhaps you can reach a wider audience that may be interested if you're doing that, and that could be helpful to the seller. But it's really not about finding like hundreds of people who might want to buy your business. It's really about finding the one person who's a good fit for your business going forward. And I think a lot of the sellers that we deal with, like, sure, price always matters. They'd like to maximize the dollars, but that's always a criteria. But they've got a business that's their baby. I mean, it could be that they built it up over a 30-year or more period, Jim, and they want to find someone who's going to be a good fit for the business, sure, but for the people that are in the business and for the customers of that business. They care a lot about those things when they're selling. So if they want to prepare their business for it, working with someone who can introduce them to the right kinds of buyers, I think, would be very appropriate, to help them meet their needs. It's helpful, of course, if the business is not, polluted with all kinds of personal expenditures, because that's a lot of work for everyone to suss out. Sometimes whether the business is, cars, trips, it's just in the seller's favor to have that kind of information available. And if they've done it, fine. I mean, it's not that uncommon, but really you want to be able to figure out, what's signal and what's noise when you're looking at the business as a buyer. So to the extent that you can prepare information that says, well, here's a better look at how the business has looked over the past 2 or 3 years, so that you can better extrapolate what the business might look like in your hands, Mr. Buyer, in the coming 2 or 3 or 5 or 7 years.
Right.
And any other information you can provide, whether it's, here's what to expect from customers. We know this about customers and where they're headed with their businesses. To the extent you can share that with the buyer, that's better. And also making sure the buyer understands what's going on with the people inside the business. It's no fun for the buyer if you've got 2 or 3 key people and they're all within a year of retirement and you haven't shared that. It doesn't mean your business is not sellable if that's the case, but you want to find a buyer who is prepared for that and understands that, because that's what's going to be in the best interest of the business.
Right. Do you find emotion and attachment to be an issue? Like, if you're looking at 10 opportunities, how often does that kind of surface and concern you?
It comes up in conversations throughout the buying process once we're engaged with a seller, but usually the seller has made the decision to sell before we get involved. And if they're working with a broker, that's probably a relationship that's developed over 6 months or a year or even longer, years in some cases. And they've usually got their head around the fact that I've had a great run. I've built something that's pretty awesome, and it's time for me to move on, and I want to put it in someone else's hands so that the business can continue. Usually they've got their heads around it at that point in time.
So Sean, thanks for joining us. Such good insight and information for those interested in buying a business. I think some of these tips are invaluable. Thinking about the overall big picture, understanding the seller's perspective, and then also for sellers, thinking about what buyers are facing, I think is really important. But again, really appreciate the conversation. And if folks want to get a hold of you, Sean, what's the best way to reach you?
Email's fine. Our website is summitridgecapital.com, and my email address is simply Sean, SEAN, at summitridgecapital.com, and can be found pretty easily on LinkedIn as well, which is always fine. Yeah, people are welcome to.
And Sean, just curious if you have any concluding thoughts in terms of advice for sellers or buyers, or anything that comes to mind.
Yeah, Jim, I think one of the themes I guess that has emerged today as we've chatted is trust, and I guess I would say an important thing for sellers is, look, they're business owners, and she or he has been in a seat where they've had to make a lot of decisions, maybe every day for a lot of years, and they're used to making decisions with, in domains they know something about, although not always with perfect information, and they get comfortable with that. But here they are doing something that they've done rarely and maybe never before, and there's a lot of uncertainty around that. And if there's one thing that business owners don't like, that they like less than risk, it's uncertainty, like we talked about, right? So I guess I would say the important thing is for them to trust the process, especially if they've selected a good broker and a good deal team for themselves. That once you're into this, if they can get their heads around the fact that they've got professional caliber people who will guide them through the process, then they can trust that they'll be equipped to make the decisions they need to make along the way, and they don't need to guess at what they don't know, or guess at what decisions they should be making that has not even occurred to them yet. So once they're into that process, I guess trusting that the seller and their broker, the buyer and their broker and their lawyer are going to guide them through the process, and as long as they sort of submit to that process, they're still going to be in charge of all their decisions along the way, and that's going to be a lot better for the seller, I think, in terms of getting a deal done and getting it to the finish line for them, anyways, right, Jim? From a buyer's perspective, I'd say it's just super important to have a great deal team, whether that's your partners in your firm, whether that's LP investors, in your deal, people that you trust and that trust you, and then you can expeditiously move forward, and that will help you build trust with sellers as well, and that'll get your deals to where you want to get them to, which is the start line.
Beautiful. No, I appreciate it, Sean. And if I can take anything away from this, it's have good deal teams on both sides and trust the process.
For sure.
But thank you very much.
My pleasure.
And for those of you interested, we've created key takeaways that you can download and access via our podcast page. Please remember to like or subscribe to keep this podcast handy, and we'll see you next time.